Hello, and welcome to our Tax Efficient Investing, How to Reduce the Tax Drag on Your Portfolio webinar. My name is Bronwen Horton. I'm one of the financial planners here at Killick & Co. And our wealth planning team. And tonight I'm joined by...
Hello, I'm Peter Day. I'm one of the partners here at Killick. I sit on the investment side and day-to-day look after our branch in Hampstead up in northwest London.
Good evening, I'm Shaun Robson. I'm Head of Wealth Planning here at Killick. I look after our team of chartered financial planners and I'm based in our Mayfair office.
Hi there, my name is William Stevens. I'm the Head of Financial Planning and a partner at Killick, and I look after our team of financial planners and I'm based in our Mayfair office.
Hello, I am Arica Gourlay and I'm a Senior Wealth Planner here at Killick & Co. and I'm based in our Mayfair office.
Wonderful. Well, while there's a plethora of tax-efficient solutions, the aim of today is to provide you with a selected way that we currently help our clients. Here we'll be focusing on providing you information only. We won't be able to give you any specific advice or recommendations. Following this, if you would like to speak with one of our planners to either review your current situation or answer a more detailed question, there'll be an opportunity at the end to follow up with us. We've allocated about 30 minutes to cover the material, and then we'll follow on with about 10 to 15 minutes of Q&A. Now, a number of you have already submitted a number of questions in specific areas that you would like us to cover. So we've already incorporated these. However, as we go through today, if you need some clarification or have a question, please use the Q&A function in Zoom, and we'll cover these in the Q&A session a little bit later. Now, given the volume of questions we often get, what we'd like to do is obviously we'll follow up with you afterwards. So if we don't answer your question immediately on the webinar, we will follow up as well. After the Q&A session, I will then go through and outline how you're going to be able to obtain the recording from today. But without further ado, let's get started. So maybe Will and Shaun, would you be able to explain why we're doing this webinar and what we hope to cover?
Yeah, thank you, Bronwen. Yeah, so the webinar today, as you've already mentioned, is to do with tax-efficient investing. Now, we'll be familiar with investing, hopefully in the general concept of that, to increase the value of your assets over time by compounding the returns. For those who have tuned in previously, we've covered in reasonable detail in previous webinars how we choose to invest. So today we'll be focusing more on the tax-efficient side of that. Tax-efficient investing in particular is a key pillar of the wealth planning service that we provide to our clients and a key element that we want to focus on. The aim of this is to reduce the tax drag on the portfolio, so to reduce the amount that is potentially lost in tax as a result of potential gains or income from your investing. And this has become increasingly important over time as allowances have moved around. In particular, over the last 12 months, we have seen a decrease in the tax allowances available for both capital gains tax and dividend taxes. Now, these may have been lost a little bit in some of the drama that unfolded in late last year through to this year, and particularly with the later changes that came through on pension legislation. But if we recap the position as it was, where it is now and where it's going, the capital gains tax allowance was at £12,300 last tax year. It fell on April the 6th of this year to £6,000, and it will fall again on April the 6th of next year to £3,000. So the amount of gain for which you were able to crystallise before you start to pay tax in any given year has reduced significantly and will continue to do so. Likewise, the dividend allowance has also decreased. So that stood at £2,000 in the last tax year. It's fallen to £1,000 in this tax year, and it'll be falling to £500 the next tax year. So as you can see, the direction of travel has been to reduce the allowances available for tax, for taxes that are paid on investments that are held outside of any tax wrappers. However, it's not all bad news. There have been some positive news within that, and we'd like to talk through some of those examples today.
Great. Thanks, Will. And so maybe, Peter, would you mind getting us started with Gilts? what they are, the current market, and why we're seeing a resurgence.
Absolutely, Bronwen. Thanks very much for the intro. So I'll maybe kick off talking a little bit about what a gilt is. I'll then come on to what's really changed recently, which has caused them to become very, very popular and probably something we've invested more money in than any other sort of investment of late. And then lastly, I'll finish by talking about a new service that we're offering in this space, where we hope we can capture the best of the opportunities in this space for clients. So I do apologize if I'm going over the obvious for some people, but starting by explaining what a gilt is. So essentially, a gilt is just an IOU, which is issued by the Treasury. So this is the way that the government in the UK borrows the bulk of its money. And it does so in simple terms, where they will issue securities called gilts, originally called gilt-edged securities, because as I understand it, when they were originally issued back hundreds of years ago, they were literally gilt-edged. Now, sadly, that's not the case, but they do still come with great security associated with them. So it's a simple promise where you lend money to the government, and in exchange, you'll receive a regular amount of interest from that security, and then you'll receive back your money at a certain stage in the future. And all those things are set out in a contract at the outset when a gilt is issued. So why do people invest in gilts? And as I say, it is a very, very big market. The government has over £2 trillion worth of gilt-edged securities out in the market at the moment. And this is the mainstay for investors such as the insurance companies, the life assurance companies, the pension companies, the local authorities. This is where they will put the bulk of their money. And the reason they do so is probably primarily down to security. So gilt investments are 100% guaranteed by the government. And whatever your view of the current UK government is, they have never defaulted in all their history on UK government gilts. And it's for that reason that they're seen as the risk-free investment. In a sense, some people would say, well, the government, if it did run into any problems, could just print money to get themselves out. So people view it that by lending money to the government through a gilt, they're doing so without taking on any capital risk. Although in theory, there is a chance that they could default. They're accessible, which again appeals to many investors. So unlike the fixed term bonds that you might have with a building society or a bank or similar, where you put money in and it will be locked in for 1 year, 2 years or 3 years, or whatever the term of the bond may be, and you cannot access them. If you should need your money back from a gilt, you can access it prior to its maturity date if necessary. And the last point, I think, simplicity. They are a very simple investment, whereas stock markets, there's all sorts of variables that can affect the performance, and you've got no defined return. You may do badly, you may do well, you could have in different years. With a gilt, it is a very straightforward investment where you know at the outset what return you're going to get each year in terms of income, and you know when in the future you're going to get back your money. So that simplicity, I think, appeals to many investors. Bronwen, if we can maybe go on to the next slide. So why are we talking about gilts now? Day to day, I think they would be considered a pretty dull and boring investment. Yes, they provide you with security and accessibility and simplicity, but they're not particularly exciting. And whilst they might be the mainstay of pension funds and similar, for the last many years, they haven't made up much of a traditional Killick & Co client portfolio. But things have changed, and for us, it's a big change, and it makes them very, very exciting at the moment. So one reason that they appeal to us more now is that we're seeing much better rates of return. So as base rates have risen in the UK, so have the rates of return available from gilts. As you're all probably aware, we got down to Bank of England base rates of 0.1% during the pandemic, but more recently, we've hit a 15-year high. We're up to about 5.25% right now, and there's an expectation that we may even go a little bit higher from there. So that has had a knock-on effect on gilts, and the rates available are higher. The next point, though, is the big one. This is, I think, what's caused the huge demand to come in from private investors in terms of gilt investments over the course of the last 12 to 18 months. They can be an incredibly tax-efficient investment, and that's why they're forming part of tonight's webinar. So what we've seen is a very, very rapid rise in interest rates, the fastest rise in interest rates that we've seen in history. And that has caused a number of what I'll describe as low coupon gilts to be trading at very substantial discounts to their maturity value. So whilst all gilts, or conventional gilts, are issued at a price of 100 and will redeem at a price of 100 at their maturity date, in between times in the secondary market, the price will be dictated by supply and demand. And as interest rates have gone up, the price of a number of these gilts has fallen. I think what I've done is actually selected a real live example, which I'll talk you through, which I hope brings it to life and explains the situation in a bit more detail. But the key point is that gilts benefit from the qualifying corporate bond rules, which means for individuals who invest in them, any capital gain that they achieve is completely free from tax, irrespective of your tax regime. That's free from capital gains tax as well as income tax. So if I may, I'm now going to start running through this particular example, one that's proven popular recently. So the issuer name, it is a UK government gilt called TN25. This was a government gilt issued a few years ago when interest rates were very, very low. And the government was able to issue this gilt with a coupon, a rate of interest of 0.25%. So they issued this bond, and anyone who bought it at that time would be entitled to 0.25% a year of interest, and then they would get back their 100 for that gilt on the maturity date, which is the 31st of January 2025. Whilst it was issued at a price of 100 and will be redeemed at a price of 100 in the 31st of January 25, today the gilt is trading in the market at a price of 93.92. So significantly below its maturity price. And that's important because if you're buying it today, what that means is that if you hang on to it until maturity, you'll get a good capital uplift from 93.92 to 100 and a bit of interest along the way at the coupon rate of 0.25%. So if you add those together, that gets us to the gross redemption yield, which would also be considered to be the total return on an annualized basis. So what this is saying is if you buy that UK government gilt at 93.92 today, you hang on to onto it until maturity on the 31st of January 25, you will get an annual return of 4.87%. And that doesn't sound particularly exciting, and I would agree it's not that exciting. Actually, you can get some cash deposits above that level, and therefore you can make your money work harder for you elsewhere. The next three columns, I think, where the excitement starts. So I mentioned earlier on that any capital uplift you achieve on these gilts are free from tax, irrespective of your tax band. So if we go to the extreme, the net redemption yield, which describes the after-tax return that you would achieve for the different taxpayers, even for a 45% taxpayer, this gilt is offering you a 4.75% annual return after tax is taken into consideration. So if we're trying to work out what the cash equivalent rate you would need to get a rate of 8.64% a year from a cash savings account to be able to replicate the same return that you're getting from a gilt. So especially for 40 or 45% taxpayers, we think there's a fantastic opportunity to benefit from all the security and safety that we're talking about and the accessibility, but also a fantastic return at the same time once tax has been taken into consideration. Bronwen, if you can go on to the next one. So we've seen a lot of demand for the individual securities out there, but I think what a number of clients have come to us and said is we don't necessarily follow the gilt market that closely, and we don't want to be needing to worry about it to any great extent. So more recently, as a firm, we've decided to launch what we're calling our short-dated gilt strategy, or our Gilt Saver product. And this is aimed at those clients who want to take advantage of the opportunity that I've just outlined there, but want to hand over responsibility of managing it to ourselves at Killick & Co. to take advantage of different gilts, which will attract different tax benefits along the way, and we will enter into different maturities as well. So you may already be familiar with our fixed income team, who have a very well-established team who look after all of our corporate bond investments. They will also be responsible for managing the short-dated gilt strategy. And so for us, we think it's going to be hugely appealing for those clients who either are seeking an attractive and reliable income, those who maybe have a slightly shorter term investment time horizon, so they can't be investing in equities and the volatility that comes with that, but actually they want to make sure that their money is working very hard for them in a tax efficient manner. Also those maybe just looking to diversify their portfolios, so the return profile tends to be very different to other assets such as equities or commercial property or whatever, so this provides them good diversification. I've mentioned some of the key benefits stem also from the tax efficiency at the moment. I think we're seeing a once in a generation opportunity where many of these gilts are trading significantly below their par value, which gives rise to these very attractive tax-free gains there. And then lastly, just for cautious investors who like the idea that their investment is 100% guaranteed by the government, rather than maybe a bank deposit, which might be guaranteed up to 85,000, however much you invest into gilts is guaranteed by the government. So the service that we're offering comes with a management fee of 0.6%, including VAT. And we would generally suggest a minimum investment size of £30,000. But if it's of interest, then I know there'll be a follow-up email address at the end of this webinar, or indeed come back to your own investment manager to ask any questions that you've got. There is one last slide that I've put on there that just gives you an idea. So Bronwen, if you can just move to the next one. So the last slide that I'm going to put up there is some of the gilts and other bonds that we may consider. So as well as investing purely in UK government gilts, there are some other state-backed entities that we're looking to invest into to further diversification and also look to enhance the yield that's there. So these are, again, very, very, very highly rated securities. So people like the European Investment Bank, or KfW, which is a state entity from Germany, you'll see that they're AAA rated, which is the highest rating that they can get from the ratings agency, which in fact, I'm sad to say, is a couple of notches higher than the UK government at the moment. But hopefully that just gives you a flavour of some of the portfolio, or some of the gilts and bonds that we may invest in within our Gilt Saver portfolio. And I'm sure you'll be hearing more from us as a firm about this new service.
Thank you, Peter, for taking us through. Taking us through the gilts. So there are other options for tax efficient investing. Will, would you mind covering some other ways to sort of save tax efficiently as well?
Absolutely, thank you, Bronwen. Well, my job here today is to try and keep it simple and talk through the key opportunities that everyone should try and make sure they're utilising before we get into some of the more complex options later on. So with that in mind, I'll start with where I left off on my previous piece, which is making use of what is left of capital gains tax allowances and dividend allowances. Now, holding investments outside of any other tax wrapper in a general investment account, or what we refer to here as KILIC as a main account, is a great way to do this. And given that there are a gains allowance still of 6,000, and although it's falling to 3,000 next year, there is still a dividend allowance. It is possible to hold an amount of investments within your own name outside of a wrapper before you start to incur any tax. On the tax point, it is important to note, obviously, that if you are paying tax, it's generally for a positive reason, i.e. you've either made a return on your investments through gains or income, so it's not all bad news. But noting that we want to help our clients keep hold of as much of that hard-earned reward as possible, the other key options to look at are ISAs and pensions. Now, ISAs are and remain the most tax-efficient way to save and invest for the long term. ISAs have an allowance each year for each individual of £20,000, which is historically very generous in comparison to the limits it has been at previously. And so if each individual can put away £20,000 a year into an ISA and invest that into growth assets, they can generate and compound returns quite significantly over the long term. The benefits of using an ISA are multiple, but the core point is that they benefit from what's known as gross roll-up, which is that they are not subject to any further capital gains tax or income tax on the investments that are held within the ISA wrapper. And then a key differentiator from any other kind of tax wrapper is that you can then access those funds free of any further taxation at the point at which you draw it from the ISA as well. So unlike other wrappers you may use, like a pension, for example, there's no income tax when you take money out of the ISA. This can make them a really compelling vehicle for long-term saving and investing, and as part of a very powerful and tax-efficient income drawdown strategy when individuals get to retirement, if they can blend the drawings from an ISA with those of a pension and keep their overall marginal rate of income tax down as a result. Now, I've talked a bit about pensions there on the way through, so I'll latch onto that a bit more now as well. We won't spend too much time on pensions for those who may not be aware, we did a webinar solely on pensions and the allowances a few months ago. A link to that will be shared in the follow-up email after this webinar. So if you are interested to know more about pensions specifically and the changes that have come into place this year and the changes that may come into place next year, then I'd encourage you to watch that back as well and let us know if you've got any questions. However, just on that, obviously pensions have had an increase in the contribution allowances this year as well. So going back to my point about not all being bad news, the pension annual allowance, the standard annual allowance for any individual contributing to their pension, has increased to as much as £60,000 per year per person. So that's allowing individuals to save quite substantially in a tax efficient manner. Now, pensions like ISAs also benefit from gross roll-up. So any income or gains made within the pension are not subject to any further taxation whilst inside the pension. When it comes to drawing from a pension, 25% of the value of the fund up to the quarter of the old lifetime allowance, what is no longer a lifetime allowance, or still is in this tax year, but won't be from next year, can be drawn out of the fund without paying any tax, and the residual fund, or 75% of the pension, will be subject to income tax at your marginal rate at the point at which you draw it out. So if you draw out £50,000, you'll be paying some, you'll have some coming through as a tax-free allowance and the rest coming through at your basic rate of income tax. Once you start to go over that, you might pay higher rate tax or you might pay additional rate tax. So there's lots of options within that. Now, on top of that, pensions are not only tax efficient within your lifetime, but they're also tax efficient from an estate planning perspective. Pensions sit outside of the estate for the purpose of inheritance tax, and therefore they can also be a very powerful tool from a tax efficiency perspective for leaving a legacy to your beneficiaries.
Wonderful. Thanks, Phil. So if somebody is actively using their ISAs and their pensions, what other options are available? Maybe Arica, would you be able to share some of these options that people can use?
Yeah, sure. So thanks, Bronwen. Now, as Bill mentioned, so it's important to make most of your annual tax allowances each year. So we've got your ISAs, we've got your pensions, we've got your dividend allowance and your capital gains tax allowance. But if you have additional amounts to invest and a high income tax bill, you may be wondering, where else can I make the most of my allowances? Okay. Now, hopefully on your screen, you'll be able to see a table I put together. So this is a comparison of VCT and EIS investments. Now, these would sit alongside your annual tax planning allowances, such as the ISAs, the pensions, and it would be a part of your broader planning. So I'm going to start with the VCTs first, just a quick overview of what they are and how they work. So a VCT is a venture capital trust. Now, this is a company listed on the London Stock Exchange. What does it do? So they're going to invest in small early stage companies to help them grow. Now, they're structured as a collective investment with the idea that they'll benefit from a diverse number of underlying holdings. They tend to take a minority stake in these early stage companies, so not just one or two, and some may do well and some not so well. So that does come with additional risk. Now, this is why the government has given them quite attractive tax benefits. So they're really trying to encourage UK investment, which would in turn benefit the economy, just trying to compensate you for taking that additional risk. So we're going to start with the 30% income tax relief. So that's the upfront relief. For example, if you invest 100,000, you would get 30K off your tax bill. But of course, you're going to need at least 30,000 to offset. Now, you also have the tax-free growth if success is happening. That tends to happen if, well, they will sell a holding and they'll pay this out in the form of dividends, which is free from tax again. So this can be another tax efficient way of generating income in retirement. These need to sit alongside your other long-term savings vehicles, and the annual allowance for the VCT is around, it's 200,000. So an example of when we may look at a VCT as a suitable investment, this would be someone with a high surplus income, large tax bill, you've used your pension annual allowance, and you have a high risk tolerance. Now, the second part of this, with income tax offset planning ideas, there is also the EIS. It's the Enterprise Investment Scheme. Now, while they're often grouped together, they are quite different from a structural point of view. So an EIS is a discretionary portfolio of individual companies, each at a very early stage. Now, as they are early stage companies, their timeline for exit for investors is often uncertain, and they are a lot less liquid than a VCT. So returns are more about capital growth and income. And well, similar to the VCT, they're also capital gains tax exempt. And in addition, you can benefit from the downside risk with loss relief at your marginal rate. You have the same 30% income tax relief on the way in, and you have additional tax benefits such as CGT referral. Now, okay, there are times when we all will, well, hopefully will have a large gain from selling an investment property or your investment portfolio. Now, an EIS may be considered as a way to defer some of that gain. So investing in an EIS would defer the gain for the period that the EIS is held. Now, on top of that, the EIS does qualify for business relief, and that's because we're investing in unquoted businesses. So business relief is another incentive by the government to encourage investment into these small unquoted companies. So this means that the EIS would be inheritance tax free if you hold the shares for at least 2 years or until death, and the shares can then be passed on to beneficiaries free from tax. So this additional feature does open up some wider tax efficient planning ideas as well. Now, an example of where we may use an EIS, it would be very similar to a VCT. However, we have that option to defer a large gain, or potentially for business relief and inheritance tax purposes. Now, it's just important to note when we're talking about these types of investments, they are higher risk, so you may have liquidity issues. Suitability for investing in these types of schemes and structures is dependent on your circumstances, attitude towards risk, goals, and this type of high risk investment strategy should only form a small part of your overall investment portfolio.
Thanks, Arica, for explaining VCTs and EIS as an option for higher rate taxpayers. But what about somebody who's got a lump sum to invest? Sean, maybe I could get you to cover this one.
Yeah, thank you, Bronwen. And we've discussed the importance of, I think, utilising all the available exemptions, allowances and tax reliefs, maximising ISAs, pension, tax wrappers, the contributions available to you. And Arica just spoke there about the opportunity to reduce your tax bill through the use of higher risk investments like EIS and VCTs. I just want to spend perhaps 5 minutes now looking at the opportunity to consider another option, which is use of offshore bonds. It may be a term some of you are already familiar with and have heard before, but for those of you who haven't heard of them before, offshore probably sounds rather mysterious than what they actually are. Maybe conjuring up images of somewhere exotic with a sunnier climate than the UK, but in reality, these investments are simply a tax wrapper like an ISA or a pension, but they are set up outside the UK in places like the Isle of Man and Ireland. They simply have their own set of tax rules that apply to them, and they typically make up part of a well-diversified financial planning strategy. Now, they are a tax-efficient way to invest money over the medium to long term. This is usually a period of 5 years or more, and they are very useful for higher rate taxpayers where perhaps they're unwrapped investments, or as we'll refer to earlier, investments that are held in a general investment account would likely be subject to higher rates of tax on an ongoing basis, given the size of that unwrapped portfolio, which is outstripping the returns in a sense that they can get tax-free through their CGT and dividend allowances. With an offshore bond, you can invest a lump sum and it can grow tax efficiently over time because you won't normally pay tax on investment growth whilst the money is invested in the bond, which when compounded over time gives you more savings for the future. And this is known as gross roll-up, a term that Will used earlier when he was referencing how investments can roll up with inside SIPs and ISAs. Income tax is only then applied when you make withdrawals from the bond in the future at a time that you're able to control when you wish to make withdrawals from the bond. In a similar fashion to your ISA and SIP and general investment account, you can choose from a wide range of investments to help you meet your goals. So all offshore bonds provide access to investment funds generally, and the providers that we work with at Killick allow Killick to manage a discretionary investment portfolio on behalf of our clients, which allow access to direct equities and bonds. You can also have the ability to switch investments within inside the bond to suit your objectives as and when they evolve over time. without any tax consequences, the same way you can change the investments inside your ISA wrapper and your SIP wrapper. When required, the money you've saved can be taken as a regular income, and this can help pay for things like life in retirement. Each year you can withdraw up to 5% of the total payments made into the bond with no immediate tax charge to pay, and this is known as a tax deferred basis. Now, this 5% allowance is cumulative and flexible. So as an example, if you invested £1 million into an offshore bond, you could make a withdrawal in the first year of 3%, and then perhaps you don't need any income or capital from the bond in the subsequent few years. And if you don't take anything for the next 4 years, in year 6, you would like to withdraw some more money, you have the ability to take up the cumulative amount, which at that point would be an initial 27% of your original investment, enabling you to access £270,000 of that original investment without triggering an immediate tax liability. Now, when the offshore bond is finally surrendered, the amount of any withdrawals that are taken are added to the proceeds on surrender to calculate the amount of investment gain, which would then be subject to income tax when you withdrew from the bond entirely. Now, for those who don't need the investment themselves, offshore bonds can be very useful for longer term estate planning, and Will mentioned earlier about the use of pensions as a way of mitigating perhaps inheritance tax planning in the future. And offshore bonds have an estate planning element to them as well, so you can choose to pass offshore bonds onto your family by assigning parts or all of the bond as a gift in the future. This can be a very useful option when trying to reduce a potential inheritance tax liability and move assets outside of your own name into the next generations. This enables parents and grandparents to perhaps gift to younger generations who themselves may be non-taxpayers or lower rate taxpayers when surrendering a bond, therefore reducing the income tax charge when the bond is eventually surrendered in the future. Now, the key to using an offshore bond successfully is by starting at the end, effectively. You need to ask, how are you going to get the money out of the bond? What's the exit strategy in the long term? And that may be sort of 10, 20, 30 years into the future. But if you're a higher rate taxpayer, it's a great option alongside the other tax wrappers we've discussed today. You can invest your money for the long term, benefit from gross roll up without having to pay any income tax on an ongoing basis. And whilst you continue to earn income over and above the top rate of tax. However, it's important to remember that whilst there's no immediate tax charge to pay, there will be an income tax charge to pay in the future. And in an ideal scenario, and with some planning alongside, a higher rate taxpayer today that benefits from that gross roll up potentially is able to exit the bond as a non or basic rate taxpayer in the future, either in their own hands or perhaps that of their families, as I mentioned, alongside a well thought through estate planning strategy. Now, I've talked about bonds being slightly more complex, and we've talked through a sort of brief overview and covered the main points. It's also worth noting that there are additional fees that will be charged by an investment bond provider, which will increase the total cost of the investment. Now, these fees, along with the taxation situation and the current regulation and legislation, should be considered when assessing any potential benefits from an offshore bond. And we recommend that financial advice should be taken around the suitability of establishing an offshore bond. On an ongoing basis, it's important to review the suitability to ensure that your evolving needs are dovetailed with the ever-changing tax situation and the regulation landscape. Ongoing advice will help manage the additional layer of tax complexity associated with having your investments managed with inside an investment bond. I guess in summary, we've discussed a number of planning options today, a combination of onshore and offshore tax wrappers that can help to optimize your financial plan. We're taking advantage of different tax treatments. We've tried to give a flavour of the different options that exist. By no means does it cover every single one of them, but this, by looking at these potential different combination of tax wrappers, you're able to create a strategy that gives you some control around when and how much tax is incurred, making use of various different personal taxation allowances as and when they become available.
Thanks, Shaun, and a huge thank you to our panel for imparting all of your knowledge with us today. If you'd like to discuss further your financial arrangements with a planner, or if you'd like to find out more about the Gilt service, please answer the question which we've got popped up in front of you. Firstly, if you'd like to speak to one of us, or if you would like a little bit further, either hearing from your your investment manager or an advisor on the Gilt service, please, I'll just give everyone just a couple of minutes to answer that, and then we will move into the Q&A section. So if you haven't already, please do pop in some questions. We've had them flooding in, so keep them coming to keep our panel really busy. Just give it one more minute. I think we're just about there. Right, so while we're waiting for the poll to finish, I'd like to move on to the Q&A section. I'm just reading through a few questions. Our first one, this is a little bit detailed, but I might see if Arica, maybe you could answer this one for us.
Sure.
So the question is, I've heard various financial advisors suggesting all sorts of schemes and ideas as to how to shelter assets from CGT and or IHT. However, the flaw of that proposal seems that they don't really address how you get the resources together to fund the proposed tax-free or tax-reduced investment without incurring CGT when liquidating the assets to provide the necessary funds. So maybe, yeah.
Yeah, no, sure, Bronwen, I'm happy to answer this question. I mean, as briefly mentioned in my presentation about the difference between VCT and EIS investments, again, look, as also Will mentioned, tax isn't necessarily a bad thing. Tax means that you've had performance, you've got a gain. An option could be an EIS, where we say, for example, we sell an investment for 50,000. It was worth the cost 10,000. That 40,000 gain, that could be invested into an EIS, so it's deferring the capital gains tax. That would be realized once you sell out of the EIS. But if you did hold that forever, that would also mitigate the inheritance tax issue as well, because that EIS qualifies for business relief. Again, they are high risk investment, so it would be dependent on the client's circumstances and attitude towards risk. But that may be something to consider long term. One thing to point out with this as well, capital gains tax rates at the moment, if we're deferring the gain and we sell out of the EIS, the rate that would apply would be at that point in time. So if it does go up, you'd be paying a high amount of tax.
Great. Thanks, Arica. The next question, possibly Peter, maybe you could cover this. It looks like the NS&I bonds are providing attractive returns at present. How does this compare to gilts?
Yeah, no, it's certainly attracted the headlines, the NS&I bond, or guaranteed savers bond, I think they call it, which a number of our clients have been calling in and asking about, because it is a market leading rate. So NS&I have offered a 6.2% guaranteed savings bond, which is a 1-year product. So you can put money in with NS&I. And I suppose the key points are you will get 6.2% gross interest from that, as I understand it, but you will be liable to your standard rate of income tax on that rate of interest. So for those that are 40 or 45% taxpayers, they'll be handing back 40 or 45% of it to the taxman on their income tax report. And the other point, which I think is an important one, is that the money will not be accessible for that year period. And I think we all know that circumstances can change, or the global economic picture can change. It might mean that you want that money back. Within the NS&I product, you cannot get the money back come what may. So if suddenly a property deal comes up that you want to take advantage of, or you need some money to help the family out, you can't access the money. The gilts, which benefit from the same 100% guarantee as the NS&I, but it does give you the accessibility, and specifically for a 40 or 45% taxpayer, I think the tax advantages way through, albeit I wouldn't want to take anything away from the NS&I. It is a market leading 1-year bond. So for those people maybe who have zero tax band, or who don't need the money for a year, then it's a very sensible thing to do with your money.
Okay. Thanks, Peter. If I can go to the next one, maybe, Will, you might be able to answer this one, just a very quick one. Where do you see the future of CGT allowance?
Thank you, Bronwen. Well, fortunately, we know where it's going to be next year. I guess the big question is, where is it going to be the year after that? So next year, the CGT allowance will halve again from where it is this year, as I mentioned earlier. It'll drop from £6,000 to £3,000 per person per annum. After that, to be honest, it is anyone's guess, and it will be dependent on who wins the next election. I mean, we will find out next year from the party manifestos what their intentions are around tax, but let's not forget that we are expecting an election in the next 18 months. And as a result, the tax rates for the 2025 tax year are sort of open to anyone's guess at this stage. So wouldn't want to speculate on where we end up, but I think the direction of travel has been generally a downwards trend in terms of allowances over the last few years, and I would expect that to continue.
Brilliant. Thanks so much, Will. Shaun, maybe one for you. So for offshore bonds, if a person withdraws 5% for 20 years, then effectively they'll get 100% of their capital back. But after that, will I pay capital gains or income tax on the gain in the value?
Right, yeah, thank you, Bronwen. Nice straightforward one for me there. As I mentioned in my example, that 5% withdrawal is flexible. So you're absolutely right. The 5% would be exhausted after 20 years if you took the 5% every single year, but you can reduce that. You know, if you took 4% a year, you could take that over 25 years. But ultimately, once the full capital has been returned to you over whatever period it is, if you want to bring the gain back on shore, then it would be subject to income tax in the year that you bring it on shore. So often we work with our clients to look at strategies to spread that across a number of tax years, whether that then leads into perhaps an estate planning strategy where you're looking at other members of the family and potentially looking at the personal rate of income tax that could be managed in the tax year that you're bringing the gain back on shore. But it is income tax, not capital gains tax.
Great. Thank you. Just looking down the list here, maybe Peter, a few more questions on the gilts. So let me just bring those up here as well. So is it just UK gilts that benefit from CGT exemption? Would bonds from foreign entities such as KFWs or the EBIs benefit from the CGT exemption?
Yes, thank you for that question. I should have covered that off. So not every bond benefits from qualifying corporate bond rules, but the very vast majority do, as long as they're sterling denominated. So those bonds that were in the slide that I had at the end, which was an EIB bond or a KFW bond, they were sterling denominated, even though the entity that stands behind them might be from Europe or elsewhere, and they are qualifying corporate bonds, and therefore they would benefit from that same CGT exemption or income tax exemption. And all the ones that will be investing within our Gilt Service will be screening them to make sure they benefit from those same benefits as the UK government gilts I was talking about. And it also applies, I should add, to other individual corporate bonds as well. So it's not just government entities. The qualifying corporate bond rules, there are certain requirements that you have to satisfy, but the vast majority of sterling denominated corporate bonds and government bonds will benefit from it.
Right. And maybe just one that sort of follows on from that. Are gilts available to private limited companies on our Gilt platform? This person's a director tasked with finding high yield for the free cash funds. Yeah, is that something that
we're seeing an awful lot of that as well. I think traditionally the banks have not been very generous when it comes to the rate of interest which they pay on deposits for corporates, because they know that there's not that much competition in the market and they don't have to pay too much. So yes, we can certainly set up accounts in the name of corporate structures and then invest directly into gilts or into our gilt service. The only thing I would add is it's always worth checking off with the accountant to make sure it's appropriate for your company to be investing in that way. It's not going to jeopardize any entrepreneurs relief or any other sort of inheritance tax benefits that may stem from you running your own company and having that money invested. There is a slight chance that you could find yourself classified as an investment company as opposed to a trading company. So you absolutely can invest for companies in gilts or the Gilt Service. I would, just as a word of warning, check it off with the accountant to make sure that you're not jeopardizing anything else.
Great. Arica, a very quick one for you. Do the tax benefits of VCTs and EIS apply to family trusts?
I think Arica's on mute, but I can jump in and cover it. I lost the button. Very easy one as well for me to cover on that front. So the tax reliefs that are in place for EIS and VCTs are personal tax reliefs. So I think the question was around, can you use sort of trustee money to invest in EIS and VCT? Well, the answer is you can, but the income tax relief that would apply to a personal investor doesn't apply to trustees and to trusts. So it's unlikely to be a sensible route in that sense, because you don't get the upfront tax relief that you would get as a personal investor. And as Arica mentioned in the presentation, that's really one of the draws of the investment, the offset for taking that higher risk with the investment.
Wonderful. Thanks, Shaun. And Will, if I can turn to you, we've got a question saying, can we spend a few minutes detailing how Killick & Co can assist with the preparation of individual tax filing?
Yeah, absolutely. More than happy to answer that. So Killick as a business is very happy to assist in the preparation of tax returns for our clients or for anyone else. We have a specific tax return service. So we have a team within the business who are able to prepare and submit tax returns on behalf of our clients. They are used to dealing with clients with substantial invested wealth, whether that be, company directors, investors, people who've got income from all sorts of sources, including buy-to-lets and other elements. So they are able to deal with relatively complex situations. The team can provide a quote for anyone who's interested. And if you are interested in learning more about that, please do drop us a message and we can put you in touch with the relevant individuals. It's relatively straightforward. We can gather all the information we need directly from you. If you're an existing Killick client, a lot of the information that we need will be available to us within the system anyway, so we can sort of cut out the middleman on that, as it were. I did spot Bronwen a second question just about tax returns, so I'll cover that off at the same time if you like, which is just on how do you get paid from investments in a Killick's Gilt Saver in terms of the income. So for clients who are invested in the Gilt Saver service, the income accruing from those gilts will be paid into the investment account which you're holding the gilts. That income would be taxable, and that income does need to be declared on your tax return, and that would be completed as part of a CTC, which we would provide to any clients on an annual basis. A CTC is a consolidated tax certificate, so that would detail any income and any gains that are taxable, so that you can provide that to your accountant, or so that we can use our tax service in-house to deal with that for you. But as Peter mentioned when going through, the point of one of the aims of the service is to invest into lower coupon and therefore lower income bonds, and focus much more on the capital uplift, which is tax-free.
Perfect. And Shaun, just a few for you, just a very couple of very quick ones. So a couple saying, are we going to cover AIM? And we've discussed obviously VCTs, but no mention of AIM. We've obviously still got our service. Are we going to cover this in the future?
Of course, yeah, thank you, Bronwen. And we were just conscious of trying to squeeze as much as we can into today's session, where we're focused on personal taxation and looking at minimising tax liabilities on an ongoing basis. Of course, we do have an AIM portfolio, which one of the benefits of an AIM portfolio is the business property relief exemption that you get from investing in AIM. If you hold that for a period of at least 2 years on death, then that part of your portfolio would sit outside of the estate from an inheritance tax point of view. We are always looking for new topics to discuss at our webinars, and we have an eye on perhaps our next webinar looking at potentially inheritance tax planning in a bit more detail. And actually, when we were preparing this, we felt it was a bit more relevant to an estate planning IHT dedicated webinar. So appreciate the feedback from people in terms of raising, that's something they may have been hoping to see. We will take that on board and make sure that we cover it in more detail. And of course, it is a service that we have here at Killick, and if you want to hear more about it, please do speak to your investment manager or get in touch, and we'll be happy to get in touch and discuss it on a more personal basis. Excellent.
I'm just going to do 2 more questions, just because we're running very close to the end. So just Shaun, just very quickly, when an offshore bond is held in trust for grandchildren that pay no tax, can and should gains rather than capital be withdrawn whilst they're still non-taxpayers?
Okay, a good question. And again, an area we didn't really have time to get onto, which is the use of offshore bonds alongside trust-based planning. And again, this is very much linked to, I kind of alluded to it, estate planning, inheritance tax mitigation. So often we will find that the use of an offshore bond underneath a trust for the next generations can be quite a useful vehicle for trustees. Again, it allows the trust investments to roll up in the same way it would do from a personal investment point of view, simplifies perhaps affairs for trustees in terms of, because an offshore bond is deemed to be what we call a non-income producing asset, it means you don't have to do an annual tax return, which can simplify affairs for trustees. I think the question was around exiting the offshore bond investment when it's wrapped within a trust. Again, without wanting to get into too much detail and making it too personal, then it's worth considering the tax position of the individuals, but importantly, when it comes to a trust, the use of those trust funds for the beneficiaries. When is the timing right to use those funds for the beneficiaries? But I think it was quite clear from the original presentation that if you're in a position where it's a non-taxpayer or basic rate taxpayer, then looking at extracting some of the gain from the portfolio at that point in time, if there is a use for the trust funds at that point in time, could be tax beneficial to do so. I would encourage those individuals to seek further advice on the options of extracting profits from the bond and the best way to do so.
Wonderful. Great, Shaun. Very last one, the last word from Peter, a very quick one. As a trustee of a discretionary trust, can the trust invest in the Gilts service?
Yes, it can. Yes, so quite a simple one there. Again, there might be some tax implications that we want to run through there, and we would, as Shaun's saying, look at further advice. But in simple terms, it can invest in the Gilt Saver Service.
Brilliant, great. Well, we are really close to time now. Thank you everyone for joining us. We hope you've found this useful. Here at Gilt, we value financial education, so hopefully this webinar is a great source of information. We've got a number of how-to guides on our website, and as mentioned earlier on, there'll be a follow-up email sent in the next couple of days. Firstly, with a survey, so we would love to hear your feedback. Secondly, the recording from today, and also the one that Will mentioned earlier, the budget one that we did back in April. And finally, there'll be a link to our planning page as well. Any unanswered questions will be answered by the team in the next few weeks. If you've got any follow-up questions, please email events@gilt.com. Thank you everyone for joining, and we'll see you all soon.